Hi there. This is a short topic video focusing on some of the key functions of profit in a market economy. So in the normal theory of the firm, we assume that firms are profit seeking and they may try to maximize profit in a market where the marginal cost equals the marginal revenue. The rate of profit they achieve, well, that depends on cost and demand conditions. Normal profit is the minimum profit a firm needs to stay in the market in the long run. That occurs when the price equals the unit cost. Abnormal or supernormal profit is a higher return, a higher margin of profit, and that's when the price you're charging is greater than average cost, oftentimes associated with having monopoly power in a market, for example. Marginal profit is the profit from the next unit sold, and that equals the marginal revenue minus the marginal cost. Typically, we assume in markets such as monopoly, imperfect competition generally, that firms will make some profit, and this diagram just is a summary of the profit maximization point for a business where marginal cost meets marginal revenue. You take up, once you found the output, you take that up to the demand curve to show the price, P1 in this case. You then use the average cost curve to find the cost per unit. And the profit is the difference between price and cost, P1 minus C1, multiplied by the level of output. So it's the shaded area. Now, why is profit important to a business? A number of reasons. Let's just focus on a few of them. I think the key is that most businesses, certainly commercial businesses in the private sector, are profit seeking, if not necessarily profit maximizing. So why is profit important? Well, fundamentally, it's a source of income for firms, and it's an important source of funding for research and development and capital investment. So a lot of businesses use the retained profits from their output to fund big investment projects in new machinery, new technology, expanding the business. And of course, they may use the cash from the profits to fund investment in other businesses, including some acquisitions. Second point is that profit sends a signal in the market. It doesn't matter whether it's a monopoly or contestable market or oligopoly. If there are significant supernormal profits, that sends a signal to other producers within the market, and it could lead to the entry of new firms and new products. And of course, that depends on the scale of the barriers to entry that might exist. Normally, we say that resources flow where the risk-adjusted expected rate of profit is highest. So typically when, for example, in farming, if the price of a particular crop is increasing, the expected profit is going up, and you'd expect over time more farmers to start growing that particular crop to take advantage. Resources are allocated in part driven by what we call the profit motive. Why else is profit important? Well, I think oftentimes it sends a signal about the general health or the strength of the macro economy. So if the supply side performance of an economy is improving, for example, higher productivity, successful innovation, then the increased profits actually reflect the improved efficiency and improved competitiveness of producers. And they feed into aggregate demand, particularly if they fund investment. And finally, profit's important from my perspective because it's an important source of tax income for the government. Corporation tax is one of the biggest single taxes in the UK, brings in many billions of pounds every year. But of course, at the moment in the news, there are big debates about the ethics of legal tax avoidance by businesses and slightly less legal practices. Huge economic and political issues about whether companies are paying the taxes that they should be. But overall, when profits are high, the government should get what's called a fiscal dividend. That flow of profit should eventually feed through to more tax revenue, and that can have significant wider benefits. Here's an example of a business, finally, which is highly profitable. Samsung, of course, has become a global multinational company, very successful, one of the iconic South Korean manufacturing conglomerates. This chart shows their level of quarterly profits in South Korean won and also in US billions of dollars, quarterly profits from 2009 to 2015. Profits have been generally rising, although clearly there's some volatility, as you can see, but the trend is upwards. So by the end of 2015, they were making a quarterly profit in excess of $5 billion. And one of the consequences of that, on the right-hand side, is the fact that Samsung has been increasing quite significantly its total spending on research and development, or R&D. You can see in dollar terms, it's increased from about $7 billion in 2009 to nearly double that in 2014. There's a good example of where profits are important, because they create the funds that businesses, large and small, can then use to fund investment and research. I think quite a tidy applied example to use. Okay, so this has been a short topic video looking at some of the key functions, the importance of profit in the market economy.